Investors who follow the leveraged loan market are feeling a bit like a New Yorker in a downpour at rush hour trying to hail a car using Uber. With demand shooting up, they're witnessing surge pricing. Uber itself tapped the market last week in a $1.2 billion fundraising to fuel growth. But overall issuance in the loan market has been sluggish in the US. Merger and acquisition activity has come off the boil, meaning fewer deals that need to be financed with debt. And private equity firms are complaining that public companies are just too expensive to justify launching leveraged buyouts right now. So loan supply is tight, just as demand is returning. Last year, the largest leveraged loan ETF suffered outflows of $1.3 billion, but it's made back half of that just since March, helping push up the average price of a loan in the main loan market index to 92 cents on the dollar from below 86 cents back at the nadir in February. Leveraged loans are low risk for investors because they've got a variable interest rate and they get repaid before bonds. However, the oil price collapse raised investor concerns about the solvency of oil explorers and other commodities plays who've borrowed in the loan market. Loan prices appeared to move ever more closely in sync with the oil price in the past few years. But recent trading suggests that link is breaking down. While the oil price has fallen back since the start of July, loan prices just keep marching on ahead. The breakdown in that relationship was overdue, frankly. Oil companies account for less than 5% of the index, and that's a fact that's sometimes become lost amid all the concerns about the high-yield bond market. It's a sister market whose index is much more heavily weighted towards the oil and gas industry. Loans offer a decent yield for conservative investors, in the region of about 4 or 5%. Uber is one of the riskier propositions. It agreed to pay near the top of that range. With ultra-low rates looming like storm clouds over ever larger swaths of the credit markets, demand for loans seems more likely to increase than decrease as long as the US economy holds up. Unlike Uber customers, loan buyers may find that surge pricing doesn't come to an end anytime soon. Stephen Foley for the Financial Times.